Good morning and welcome to the Abundant Retirement Show from Ross Wealth Advisors. Don Ross, the retirement. I'm pleased to be here with world-renowned author Don Ross, who is also you are world-renowned. Maybe not for your writing, but you're, famous author, I guess would be reasonable to say. Don Ross, the retirement boss from Ross Wealth Advisors. And another Abundant Retirement Show on a Sunday morning here on Rewind. We appreciate you tuning in. And
yes,
at some point, you'll be able to go back and listen to all of these wonderful episodes of the Abundant Retirement
I'm sure
Show.
You're waiting in line to do that.
Indeed. As the podcast becomes available, that's something we will certainly inform you about here on the program. I would like to just right off the bat give you the opportunity to have ways to get in contact with Ross Wealth Advisors and Don Ross. We're space age these days. Texting is so easy for so many people. It's become just it's just second nature for a lot of people to text. You can text Ross Wealth Advisors. They have a special Ross Wealth Advisors Don hotline text. It's 797979. Those are the digits you put in. That goes in the to box. You're sending that message to 797979. And then, there's an egghead out there somewhere that translates that electronically, and it magically ends up in Don's
inbox.
In Don's text inbox. So 797979 is the text access to Ross Wealth Advisors. You can be more traditional and pick up your phone and dial 614-545-0277. That will get directly to Ross Wealth Advisors during normal business hours. Or if you call right now, you will reach someone who will help you.
Yep.
And Don will get back to you as soon as he gets the message, which will be very prompt, as a matter of fact. The website, a wealth of information and a great real introduction to Ross Wealth Advisors. It's rosswealthadvisors.com. We try to make it as simple as possible because I don't need to be any more confused than I am. And email don@rosswealthadvisors.com.
Okay, now we've loaded up on all the different ways of
I want to get all those things out of. Well, you know what? How frustrating is it? And I've been there before where I hear someone who is maybe, say, talking about a product or a program or something. And I think, wow, I'm interested in that. And they never get around to telling you how you can get connected with it. And that's really important.
And if you forget numbers and like that, if you literally go to Google and type in Ross W, it'll pull up Ross.
That's all you need, Ross.
You don't
get anybody from Friends.
We're high on the SEO list, that SEO stuff, which is search engine optimization.
That's important.
But it's about getting in touch to help you start asking questions of us on retirement planning concerns, which for those of you retired or within 10 years of retiring, this is our expertise as it deals with income planning. Are your investments appropriate? Taxes, all of those things you need to be aware of, whether you're retired or within 10 years of retiring.
Yes, so, you are definitely the audience that Ross Wealth Advisors and Don himself is here to serve, here to super serve, really. That's one of the other elements of Ross Wealth Advisors that you will quickly come to understand.
And how we do that is we focus on quality of life and what are you doing now to make sure that you can have that abundant retirement, whether you're 10 years out or are retired. And so today,
it's kind of funny, Don, and an observation I've made before, and I've never actually vocalized it, but I will here. We're talking really about people's lives. And about their retirement life, and that's what you always focus on. And I think a lot of people are surprised by the fact, at least I was initially, that you're not talking. You're not talking about money. This is not about money. Ultimately, it is, but it's about lifestyle. It's about your life. It's about how you're going to enjoy your abundant retirement. And I love the fact that that's what you focus on from the beginning, from the absolute very beginning.
Yeah. I've used the samples before where, traditionally, if it's a husband and wife, the man will come in and want to push over his 200-page brokerage statement. And I'm like, I don't really care about that. Now I need to know who you are. It doesn't matter
at this point, right?
And ultimately, if we're a fit, if you want our service, and if we see eye to eye, and we have a philosophical agreement on retirement planning and all that, and so it's important. And that's part of the reason today I want to talk about my book.
And why I'm here with famous author Don Ross.
Yes. Now, some of you might like that name because There's a famous golf course designer named Don Ross.
Yes,
so you golfers,
we have to differentiate between the two famous Don Ross.
So that, being my name at certain golf courses gets me a discount of nothing. So like Plymouth Country Club or Sauter Country Club, these are Don Ross golf courses that, as a golfer, I can go a long way with that. But what I want to talk about today, Joe, is the book I wrote in 2012. I'm editing it to the third edition today. I want to talk about how to get that into your hands, as well as I always am talking to you about the portfolio MRI to make sure your portfolio doesn't have the unnecessary fees you're paying, or more or less the risk, or we call volatility, meaning how much could you lose the next time we have a 2008. And so I want to go over the book a little bit today.
Absolutely. I figured this was going to be the easiest day of my life, because I'm just going to sit back and listen to you talk about, I'd start at the beginning and actually go back to how and why the Retiree Survival Guide even came about, and what prompted you to even want to do that. And then we can, progress through where you are today, which is working on the third edition, in fact.
Okay. So as you step down the hall to get your coffee, I'll get going on this.
I'll be over here if you need me.
So about 6-7 years ago, a colleague of mine suggested, as I'm talking about writing a book, so you, the consumer, can read it in the leisure of your home, and it's about a 2-hour read. It's 10 key chapters, but he said you ought to use something related to your military background and all the things you've learned on how to have a backup plan in life. And so it's a survival guide, because it's like the survival guide I received in boot camp in 1982 as an 18-year-old punk going through boot camp. And the survival guide shows you all the techniques and strategies and ideas on how you would protect yourself or survive, depending on the scenario you would be in based on a war or something like that. So I wrote this book. I designed it through 10 chapters. Okay, Joe, it's 10 chapters.
Not War and Peace. I mean, you don't have to dedicate an entire month to it. No doubt.
Could be,
no doubt.
But no one will read it. And this book, this book, it's not on Kindle or anything like that. It's the reason why I want to hand it to you in person or send it to you is because the process of our relationship is understanding our style and deciding if we're a good fit. So of the 10 chapters, I thought today we'd just touch on chapter 1, and it's sitting right here in front of me. It's titled Investing. There's so many different ways to invest with mutual funds and ETFs, and many of you, I would bet over 90% of you are investing in a company 401k plan or a 403b if you're a school teacher, or the TSP if you're a federal employee like the postal carriers, or if you work at DCSC. Inside there, you're making choices, whether you're aware or you're kind of blindfolded. You're making choices on which mutual funds to buy. Now, one of the things that's important to understand about mutual funds is how are they designed and what's going on with them. At the end of the day, if you're not getting the returns you are hoping for, and I'm talking about legitimate returns on your portfolio, it's because you may have hidden fees dragging it down, or, as I want to discuss in the book, the different myths, not to be confused with the 4 myths of retirement we went over the last couple of weeks, but the myths of understanding past performance or chasing returns, or a great fund manager, aka many of you may remember the name from the 80s, a guy named Peter Lynch of the famed Fidelity Magellan.
Yeah, indeed.
Even he says, I got lucky with how well we did. And so there's a lot in this chapter, even though it's 5-6 pages. It's a 30,000-foot view of what you need to start being aware of so you can grow your money at the lowest cost and the least volatility. And just think of volatility, everyone out there listening, as, you're running across, 71 in rush hour traffic. It could be a little exciting as opposed to running across 71 at 3 in the morning when no one's out there.
Right. You still got to cross to the other side. You just have a lot less risk of getting hurt on the way. And that's a great analogy, because, again, we've discussed this from time to time. One of the things you don't want to have happen when you are retired, or you're, retirement minded within 5 to 10 years of retirement, is getting hurt because it's just as our bodies get older, we tend to recover more slowly. And with retirement, you don't have as much time to recover. You may not have the
you don't have
to
time
recover.
At all. That's
and so you don't want to get hurt for a lot of reasons, but mainly because you don't have the time to recover.
Because the sooner you get, or the closer you are to retirement, the less time you have, and you go from accumulating, which is easy, to distribution. So chapter 1 of my book that I'd love to get in your hands, and you could text book to me, you could call, email, is the myth of reported returns. Basically, a lot of the returns that you might see in mutual funds when you read certain financial magazines are not audited, and so they may not be exactly accurate.
But maybe presented in the best light possible, perhaps.
Right. And the other thing you have to understand is the magazine you might be reading, who owns it? Many of them are owned by mutual fund companies.
Right, sure. So again, why wouldn't they want to put their product in the best possible light, short of not being honest? I mean, they certainly,
No.
You can certainly make something look much better than it does, depending on how you write about it.
So one thing you'd want to know is, are any funds you in, are they CRSP audited? That's CRSP, and that stands for the Center for Research and Stock Pricing. Any investing we do for our clients is CRSP audited, and returns are audited, means they are accurate. So if it says you earned 4.8%,
it's 4.8%.
Yeah, okay. Not 4% less. Okay.
It's not an inflated number that is maybe accurate in some respects, but not in fact the true number.
Well, the other thing is it's kind of hard to do math on the radio, but if you would look at returns over a 5-year period, I could show you a fund that had twice the return 2 years in a 5-year scenario than another fund, and the second fund had a better return overall. And that's averages, and you have to be very careful understanding if someone says, hey, we did 12% over the last 5 years, what does that really mean?
Right.
As far as appreciation of your portfolio.
Because that's the important thing. I mean, the ups and downs, the volatility is one of the things that you must be aware of. And,
yes.
12% over the last 5 years. What'd you do last year?
In other words, if you, you understand if you lose 10% one year, what do you have to make the next year? It's not 20, but it's now more than 10.
It's more than 10.
Yeah.
Yeah,
and
absolutely. And then what
invest.
and if you're seeing just hypothetically a return of, 8 to 10%, and you lose 10% one year, the chances of you making it up next year are not good. And that's just to get back to where you were.
Yeah. The other thing I want to discuss before going to break is a little thing called turnover. So now imagine you, Joe, you and I, or anybody out there listening, you're the manager of a $1 billion mutual fund. And that mutual fund, to appreciate all the investors' money to grow it, has a 60% turnover ratio. Now, I know I'm doing numbers on the air. What that means is of those 100 stocks inside there, 60 of them have been bought and sold. And what that's creating is a cost that you don't see. And I even quote John Bogle, the founder of the famed Vanguard mutual funds. That can cost you. Now, if you come in and we sit down, and I'm going to invite you to come in, I'm going to show you how they can cost you upwards of 2.5% to 3% of your returns.
Holy moly. Yeah. That's a lot.
Well, it's not 6%. Let's say you got 6% and you take away 3, you netted 3. No, it doesn't mean that. It's a percentage of how much is your fund turning over stocks, which is the turnover ratio. It can get very high. I've seen it as high as 400%. So who's making money? Not you.
Not you. and that's the key thing to remember right there.
That's exactly right.
And another thing to remember is getting in touch with Don at Ross Wealth Advisors. The email address is Don at Ross Wealth Advisors. That's an easy one. It's a no-brainer. Calling the office is as simple as dialing 614-545-0277. If you want to text, do that. Put anything you want in the subject. Book, MRI.
Book or MRI today.
Retire, help. Don, please text me back, and he will. The number is 797979. That's 797979 for Ross Wealth Advisors.
Joe Bradley here with Don Ross, the retirement boss of Ross Wealth Advisors, and we're discussing retirement planning versus retirement income planning. It's just a one word, but big difference, right, Don?
Absolutely. Significant difference, Joe. Retirement planning is about growing your assets, like in your 401ks, your IRAs, deferred comp. So when you retire, you have that money to enjoy that abundant retirement. Retirement income planning is different in our area of expertise. Remember, when that paycheck stops, everything changes. Are your assets positioned and invested properly to generate reliable income, regardless of what happens on Wall Street or Main Street, and more importantly, how long you live?
So Ross Wealth Advisors is really about specializing in this, right?
Absolutely. Any mistakes during this phase of your life could be catastrophic.
Whether you're retired or within 5 years of retiring or just have concerns about whether you're going to have enough money, call Don's office and schedule a complimentary visit. The number is 614-545-0277, or you can simply visit rosswealthadvisors.com.
We're back on the Abundant Retirement Show. Ross Wealth Advisors, Don Ross, the retirement boss and famous author, sitting next to me today. I'm excited to have a famous author with me today, and it's my buddy Don, and he's still here. And talking about his retiree survival guide, his book that has been in the hands of many and has certainly done a lot toward helping open the eyes of many people who are retired and retirement-minded within 5 to 10 years of retirement and wanting some answers to questions that they may not have even been aware of until they crack the cover of your very quick, easy-to-read book. I know it seems hard to imagine that a book about retirement and financial information and investing and portfolios would be easy to read, but in fact, I mean, it is easy to read. It doesn't get down into the wormholes where you're like, okay, I don't even know what this is about, and I got to put it down. It's not like that at all.
I think it's a rabbit hole.
It's a wormhole, rabbit hole. I'm going small today with a wormhole, but rabbit hole is even better.
The part of the reason I wrote it is for educating the consumer. I had 5 clients even help me edit. Now, I'm not trying to say, hey, I've got a book and I'm great. I'm trying to say I want to educate you, the consumer, that may be concerned about your investments. When's the next market going to correct? What about taxes? I mean, we do all of that, but I want to make it easy for you to reach out so we can get to know each other, or as I use the term, raise your hand, whether you text, email, or call. I think it's a great idea to just start with the book. So we're in chapter 1 about investing. There's 10 chapters.
And this is the third edition of the Retiree Survival Guide.
I'm just updating it. We're in 2018. I wrote it in 2013 originally. So we talked about turnover, which is robbing you of return. That's the fund buying and selling. And again, most of you have these in your 401k or 403bs or deferred comp. And by the way, there's a little trick. If any of you ever wanted to continue paying into your 401k but wanted to diversify outside of it, I can show you a little known trick that allows you to do that. And now we're overseeing and helping you make decisions. So the next thing that's important that I talk about are the myths of past performance. A lot of people will rely on information in like Money Magazine. I'm not picking on money, but
it's one that's well known. People
and reading these returns.
Absolutely, recognize it right away.
So, but again, any of those financial magazines, you have to look to see who's buying them or who owns them. Who owns them? The other one is chasing returns. Now, this is huge. This is one of my 3 biggies. That the problem with chasing returns is you're buying past performance. If you're getting out when the market's declining, when are you going to get back in? And a lot of people, maybe you, when you're picking your funds in your 401k or investing outside your 401k, many of you will look at the 1, 3, and 5 year return, right?
Sure.
Okay.
I mean that's really
human nature.
It is human nature. You want to see, let's see how, it's like if you were picking a guy to call up from the minor leagues to the majors. I mean, what are you going to look at? Well,
but you have no idea what he's going to do when he gets to the majors.
You have no idea, but you're going to, what are you going to look at? What are you going to look at?
Unless
how
you're
he did in the
Deion
minors. What's his batting average? How's he hitting? How's he running?
So it's, past performance, as you mostly know. But one of the 3 key things when it has to do with returns is don't chase returns, don't time the market, and don't stock pick. Those are all 3 things. We have lots of data that proves that it doesn't work. There's another myth that I write about in chapter 1 of my book, the great fund manager. Okay. Sure, in 2000s and early on, there was managers that had great returns.
Sure they did.
Many of them admit, hey, we got lucky. There's another one, the hide the losers. What happens is some of you have experienced that your fund that you were either tracking or you were invested in disappeared. Why is this? Well, it didn't perform well, or absolutely it was horrible. You could have put your money under the mattress and done better.
At least it wouldn't have gotten smaller.
Right. So another fund in that family of funds will absorb that fund you were in. Okay. So people don't even know about that. And then, of course, timing. If I could convey one thing in my life of advising people for the last 30 years, do not time the market.
Don't try.
If you have and got lucky,
you got lucky.
Well, that's lucky.
And
it won't happen again. I mean, how many times can you go to Vegas or right here in Hollywood Casino, and walk out of there every time winning? Timing
not very
is not
often.
going to work.
You might once, you might even twice, but it's not going to happen. It's luck. And you don't want luck. You don't want luck to be the determining factor for your abundant retirement. That's not. Luck is not what it's about.
Part of what I believe in is in how we invest our clients' money. Which, by the way, I subscribe to my own philosophy on how I advise you. I do the same for myself. Timing the market. There's empirical amounts of data here too. That's why I like my information that's Nobel Prize winning and it's also academically proven. Large amounts of data show that, you know what, timing the market will not improve your returns. You have to stay invested and you have to be diversified. Absolutely.
It makes sense.
When do you get back in?
It makes absolute sense. I mean, when you're going on luck, you're going to have winners and you're going to have losers. You're going to have more losers than winners. So it really probably doesn't have a positive impact.
Well, some of you might remember early 2016 when the markets really, really, it was a tough part of the year. And a lot of it had with the exit strategy from Brexit, and all that.
Yes.
So if you have a money manager that you chose through your 401k or whatever, some of them went to cash. The question is, when did they get back in to capture those returns? Because there's lots and lots of data, folks, that shows that no one knows when to get back in. That's why you have to stay invested and be diversified and invest at a risk tolerance you're comfortable with. Too many of you are invested as if you're 30 years old and you're 55 or 60 like me. That's too risky. You have to be careful. Unless you have gobs of money you don't care about, but most of the people we provide maximum value to don't. They want to make sure that they have this money to last their retirement, which could be 25, 30 or more years.
Well, and even if you do have gobs of money, who wants to just throw it away down the rabbit hole, as you say?
Right.
Yeah, you don't want to do that. Nobody wants to do that. I don't think.
No.
If they do, I'd like to meet them. I've got a rabbit hole they'd be interested in.
There's the buy and hold strategy. The question is hold till when. So we bring in a strategy that is constantly rebalancing. Now, there's a discussion out there, if you do some research, that there's active management and there's passive management. Okay, little guy named Warren Buffett you may have heard of.
I have heard of him.
He's more of a passive, own equities and rebalance. We subscribe to that. Active management is what? I know when the stock's going to go up. I'm going to buy it when it goes down. And it's too risky for the clients that I serve to be actively managed. And so we like the more of the passive. And again, going back to academic information and Nobel Prize winning information, I kind of like that strategy because here's what's interesting. I know I'm throwing a lot of numbers out on a Sunday morning, or maybe you're listening on the new podcast. 91.5% of any portfolio's growth, or we call it appreciation or gain or whatever you want to call it, comes from proper asset allocation. Now,
so more than 90%.
So let's invest that way, and I'll show you how to do that. And if you do have this in a 403B or 401k and they're still working, I can show you how to get that money out on a tax advantage basis and build a portfolio that I can show you how to build that's diversified and makes sense. So if 91.5% of a portfolio's growth is asset allocation, proper asset allocation, well, then what's the other 8.5%?
Right. That's a good question. What is it?
The other 8.5% is stock picking.
Okay.
Chasing returns. Okay, and that's, picture yourself, I kind of do this in the office when I'm with clients. I cover my eyes with my left hand, and I take my right hand, and I act like I'm picking funds.
Okay.
And I'm blindfolded.
Well,
chasing returns.
Which largely, if that's what you're doing, you are. I mean, there's a lot of information out there, but guess what? None of it tells you. None of it tells you the future. It only tells you the past, maybe up to the present, and that's it.
You can't tell the future.
Exactly.
The beauty of the markets, and all of you are in it, if you're in mutual funds or ETFs, is that it's random. That's the beauty of the markets, because all the unknown and known information out there is built into all those different stocks you own, whether you own them individually, which many of you do, or you own them through a mutual fund in your company-based plan, like a 401k or a 403b or deferred comp with Ohio. So that's what's important to understand is what am I paying in fees? What risk am I paying? How much turnover is going on? And then here's the last one, overlap. So, hey, I'm well diversified, Don, is what I hear from a lot of people.
I'll bet you do.
Yeah. I have these 15 mutual funds. And by the way, my old 401k, my old employer, I left it over there. So that's diversified.
So you figure, hey, yeah, I'm in 16, 17 different places. So I'm good. I'm diversified, right?
I call that your financial junk drawer. Now, my MRI that I want to do for each one of you out there, just give a call, text, or email, will uncover all of that. And then reading my book, starting with chapter 1 on investing, I'm going to educate you on what you should be aware of. And here's the beauty of that. Now you're educated, which makes you an informed consumer, which gives you what? Power.
Indeed.
Power means a lot. And if you have an advisor that you would never leave, now you go back to your advisor and say, hey, I need to know about this.
Tell me about my overlap.
And turnover and hidden fees. And I had a review with a client, been with me about a year. She had left one of the big brokerage houses because she asked for 2 or more years, what fees am I paying? And finally her broker didn't tell her. And she came and met us, came to one of our events, read the book, went through our 4-step planning process, and was just in the other day and is just happier than I don't know, but she's happy, she's content, first time in many, many years, and that's important. That's quality of life. That's retirement planning that I want to bring each and every one of you that are listening that want to reach out and get to know me on a one-on-one basis and see how we can bring you value.
And that is the important thing. Again, we're back to the quality of life, and that's really what it is all about. It's about your abundant retirement. And it's exciting that you're continuing you're starting a new edition of the Retiree Survival Guide, issue 3.
It's cool. It's going to be all camouflage 3. Looking. And,
nice.
It's pretty cool. I share a little bit about my background.
J.K. Rowling probably with your distribution of the Retiree Survival Guide now.
Gosh,
you may as well just hang up the whole,
Sell as many books as she did.
The Harry Potter thing is going to be eclipsed by this. I mean, it's certainly a lot more important when you come down to it.
I wish I had a snare drum and a single.
Yes, yeah, we definitely need a rim shot. We'll have to implement the rim shot into a future program. Indeed. Hey, but past programs are going to be available as podcasts, by the way.
And we'll push that out to everybody that sends me an email, want to be on the podcast.
Yes.
You can search for us. Like I said, you can type in Ross W. Don't even spell the whole name out, and you can find me. And love to sit down with you one-on-one, 45 minutes max, just to see, hey, how can we bring you value? Maybe you're a little skittish, a little nervous, and maybe you just want to have a chat on the phone. Not a problem.
And you can do that. A simple way to get in touch, first thing is phone 614-545-0277. That's the number at Ross Wealth Advisors. 797979. While your phone's in your hand, you can use that to text. 797979 will get you directly to Ross Wealth Advisors as well. If you prefer email, if you sit down, say you're sitting down on a Sunday morning and maybe you don't tie yourself to your email a lot. And, today morning is when you do that and you're going through your emails that are in your inbox. Hit Don up. It's Don at RossWealthAdvisors.com. And he
shoot
will
me an email. Love to have a dialogue. Yep.
It will, and it goes to Don directly, and your response will come directly from Don as well. And RossWealthAdvisors.com is the website. That's an easy one to remember. It's a no-brainer.
Absolutely.
It's a good place to get started. And we'll be starting on out of here and back next Sunday morning with another episode of the Abundant Retirement Show from Ross Wealth Advisors.